Welcome back to Finance Bro University, brought to you by Professor Mangosteen. This episode, we're asking the question, what is alpha? Finance Bro University is here to set you up for the new paradigm in finance. We're going to master the old rules and then we're going to break them. Brought to you by Professor Mangosteen, with a background in finance, economics, and accounting and engineering, broad experience across corporate strategy and finance, and a desire to cultivate the next generation of investors from suits to steel caps, no matter your background, through renegade financial education and strategy. So you've heard the quotes on social media. This channel gives you so much alpha. This strategy/guru has so much alpha to offer everyone. Follow me for more opportunities for alpha. But what on earth is alpha? Well, alpha is the measure of someone's ability to outperform the expected benchmark return, i.e., alpha is your return minus the benchmark. If you did 12% return and the benchmark is 10, then your alpha is 2%. But what is the benchmark return, I hear you say? Well, this Muppet won a Nobel Prize for deciding what it was. William Sharpe developed the capital asset pricing model, and that is used to determine the optimal portfolio from which you can derive a benchmark from. This optimal portfolio is considered the benchmark return. So what is the optimal portfolio? Well, the optimal portfolio is called the ideal market portfolio, which we can see here in this graph. So on the y-axis, we have expected return measured in percent per annum, and on the x-axis, we have expected risk, which is a measure of volatility and standard deviation of those returns. And what we have is all these different portfolios or individual assets that we have that have an expected risk and expected return, and we can look at some of their historical volatility and the historical returns to understand where they play inside this, and we can weight them in different ways to then determine what the efficient frontier is. Now, this is the efficient frontier, and at this intersection, we get a linear line between the risk-free rate, which is the rate of return you get from your central bank, and this market portfolio return, and then we can leverage up to increase our capital returns over time. The optimal portfolio maximizes the expected return for any expected unit of risk. So here we can see that the optimal expected rate of return and the optimal expected risk sit somewhere here. And we can leverage up our portfolio to say that rather than buying different assets, we can just use more debt or less debt to determine the amount of return and risk that we want to experience. So up here, we're holding the optimal portfolio and some leverage, and down here, we're holding the optimal portfolio and a bit of cash. The optimal market portfolio consists of assets available in that market to you. Now, it's really important because you can define the market as broadly or as narrowly as you think is relevant or accessible to you. You could have a global, a domestic, or even a specific portfolio mandate that determines what is the accessible market of assets that you can put into this portfolio to determine what your efficient frontier and your efficient capital market line is. And this is where it gets very subjective. So this is where you can go about defining your benchmark. You could have an optimum portfolio of the S&P 500 or the NASDAQ or the ASX and generate 12% a year annual return, or you could have all global equities and maybe you get 8 to 10%, or global equities and bonds and get 7%. Or you could have commodities and maybe they sit around 6%, or you could just say, hey, my benchmark return is Bitcoin and it's 60%, or you have some sort of Bitcoin, equities, crypto, such and such mix, or you could say that you want to beat Mangosteen, and Mangosteen is your efficient portfolio, and you're going to compare yourself to the benchmark, and I'm generating something around the 88% return mark, which means that you get a very high threshold between when you generate alpha over and above me. But if I were to compare myself to the market, I might say, hey, I'm doing 88%, the market's doing 12%, I'm generating like 60% alpha a year. That's very, very different, and I've got a very, very high cost of capital. If I'm confident of my ability to consistently generate 88% returns, then my cost of capital was 88%. Another important concept is the slope of the capital market line is your Sharpe ratio. And what we can see here is the Sharpe ratio is how much expected return that you expect to receive in exchange for the expected amount of risk that your portfolio is going to endure. And if you have a higher Sharpe ratio, a Sharpe ratio that beats the ideal market portfolio Sharpe ratio, then you have a really, really powerful Sharpe ratio. And this is considered the ultimate measure of portfolio performance. A portfolio with a Sharpe ratio that is better than the efficient market Sharpe ratio generates higher returns for the same amount of adjusted brackets risk, which would make you a good investor or stock picker in the eyes of traditional finance people. You can also assess individual assets on their expected return and expected risk profiles and measure their Sharpe ratio. Generally, you want to own assets with the absolute highest Sharpe ratio possible. This wouldn't be Finance Bro University if we didn't call bullshit on some of this. Why is the capital asset pricing model bullshit? Well, it relies on key suppositions. Now, these suppositions, things that CAPM need to be true is, one, the risk-free rate is defined by a government treasury market. And there's just no such thing as a risk-free rate in the world of Finance University. There's a contrived rate that we'll look into in more detail. Two, volatility is used as the proxy for risk. Now, this is really important. Volatility does not equal risk. And this is a really, really important thing to understand. And this is something we're going to explore in more detail. Three, the expected return is nonsense, and CAPM is fundamentally rear-view facing. We're looking to the future, and if we say, hey, look, these assets generated these returns historically, and for this much volatility historically, there's nothing to guarantee that that is going to be the case in the future. And so we're going to have to be more nuanced in how we view this. So let's spend a minute deep diving into each of these three concepts. There's no such thing as the risk-free rate. A risk-free rate exists as a product of a Keynesian central banking economic model. Now, this is by far the most profound aspect of CAPM. Central banks create a risk-free rate. In the US, it's the federal rate. In Australia and New Zealand, it's called the official cash rate. The problem is yield on central bank treasuries does not outpace the money creation necessary to make it bunny ears risk-free. You pay for this risk-free in the rate in the form of monetary dilution. And monetary literacy is going to be a key tenet of this channel, and it is as important as financial literacy. And the best thing that I can take about risk is that as a result of this, there's no real true risk-free rate. And we need to bake this into how we look at our investment decisions moving forward, is that the risk-free rate is contrived. We will be spending a bit of time on this topic. Volatility does not equal risk. Now, volatility and risk are not all the same or really comparable at all. Now, we've got two examples here. We've got low volatility from the result of fraud on the accounting books of an organization, let's say like an Enron sort of thing. And on the right, we've got a high volatility, but from legitimately operated business, right? And that volatility shows up in their statements because they're not trying to hide anything. Now, here, prior to this collapse, we would have looked at this stock price gone, oh my God, there's almost no volatility and it's generating great return, Sharpe ratio through the roof. Like you're an amazing stock picker for buying this. And then on the right, we would have said, hey, look, you're generating all this volatility in your portfolio. You're not a very good stock picker. Are these returns worth it for the volatility that you're experiencing? We don't know, blah, 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 blah. But the thing to understand is that the Sharpe ratio and alpha are generally thought of as more volatility optimized return metrics. They're not risk optimized return metrics. And this is really important distinction. And in these examples here, you can see the importance of that distinction. On the right, we experienced high volatility. On the left, we experienced tremendous risk. This expected rate of return is crystal ball gazing fundamentally. Fund managers build these big fancy macroeconomic models to support different scenarios. These models can get pretty sophisticated, modeling how organizations may fare economically under different economic circumstances. But fundamentally, what they're doing is trying to boil it down to a most likely or a weighted probability outcome at the end of the day. Their true measure of the Sharpe ratio and alpha is always a historical looking measure, and that doesn't mean that in the past it's going to look into the future. Obviously, we can't predict the future, but we can make assumptions or use structural ideas to say, hey, how things will play out, and we're going to explore that in more detail. So to wrap up this episode, alpha is the excess return over your benchmark. Defining your benchmark can be as scientific or as subjective as you like, and you can put as much effort or as little effort into it as you could possibly desire. CAPM, the foundational model of alpha, is a flawed model used by Muppets to mostly sell you low-performing investment products. In this episode so far, I've only briefly scratched the surface of my critiques of the CAPM model and the broader finance landscape that we're going to explore in more detail. So if you feel like I've glazed over things at a high level, then do let me know about what more detail you want me to go down to, but I am going to go down into much more detail on some of these critiques. And as usual, my normal disclaimer, this channel does not provide financial advice or any advice of any kind. You must do your own research. Any investment or trading decisions you make are your own. This is entertainment only. You are listening to a random Mangosteen on the internet. So I hope you've enjoyed this Finance University episode. You can find me on X, YouTube, and my website, mangosteen.global. Thanks again. Like, comment, subscribe. If you've got any feedback, hit me up in the comments. I do read all of them.